IIP data, we have our esteemed panel lined up. For now, we have Shivam Chakravarti line again, and we'll also bring in Rupa Rege and Ashutosh Khajuria in just a bit. But Shivam, before we come to you, let me bring in my colleague Ritu Singh. Ritu, you've been doing the poll for the April IIP. What can we expect? There are several sectors that were reeling under pressure over the last 2 to 3 quarters. So what is the broad expectation that the market is expecting this time around?
Well, according to CNBC TV18's poll, what we understand is that the April IIP is seen as at about 0.86%. Remember, Kritika, last month's IIP, which is March IIP, it comes with a lag of 2 months. That stood at 0.1%, also quite weak for the last, since November. In fact, we've been seeing sustained weakness in the IIP numbers, mainly led by a drag in manufacturing. And even in this quarter, although we're expecting some sort of an uptick from March, there is likely to be continued and persisted weakness, mainly again on account of mining and manufacturing. Remember, in the IIP bucket, 80% of the weightage is given to manufacturing and 10% to electricity and 10% to mining. So manufacturing alone plays a huge role. The core sector data that came out for 8 key industries, including infrastructure, that data showed, at least in April, it touched a 17-month high of 8.5%. But again, that is only 38% of the basket. So it'll be interesting to see if for this month there's any improvement, especially given on the back of the GDP numbers, which remember were at a very good 7.6% in the previous quarter. So we are hopeful. We're still waiting for the numbers to see how they actually pan out.
Okay, so let's get our guests in as well. We have Shivam Chakravarti, senior economist of HDFC Bank, and Rupa Rege joining in on the phone line. Shivam, coming to you first. What is your expectation broadly? Ritu was pointing out the key numbers. Okay, we have the numbers. So the April IIP is at a negative 0.8%. This, remember, is versus our poll. So Ritu's poll had thrown up an increase of about 0.86%, and this time around it's coming at a negative 0.8%. Ritu, first up, quick analysis before we get a guess.
Well, this is very, very weak and much below, obviously, what we had anticipated, even though our range for the IIP number was minus 0.6 to plus 3%. This is very, very surprising. This clearly shows that manufacturing has, weakness in manufacturing has sustained. What is also interesting is, there is a growing disconnect in the economic data. We're seeing, as I pointed out earlier, the core 8 sector industries data.
Okay, we have the manufacturing data, Ritu.
The manufacturing data, which is the key in, it holds about 80% weightage in the IIP basket. That number is out for you. The IIP numbers will shortly be on your screen.
And that's the reason why it's down. It's down by 3.1%. Now, last time it was down by about 1.2%. So
yeah, that's a very bad dip. In fact, October was a high of 10.6%. Since then, manufacturing has been contracting, barring the February exception of 0.7%. So manufacturing clearly is a big dragger here. Other than that, we yet to see data from electricity and mining. That will also be crucial.
Okay, so let's get our guests in quickly, and the PIB website, as always, playing hooky for now. So Shivam, coming to you quickly, your initial take on the numbers, negative 0.8%, below expectations, obviously?
Yeah, it was below expectations. We were expecting about a 1% increase, which was sort of very similar with the sort of consensus expectations. I think, yeah, as you pointed out, manufacturing growth has remained fairly weak, and what is sort of becoming more apparent is the divergence in sort of industrial sector performance, where the infrastructure sectors are sort of performing really well, driven by, public increase in public support, whereas the manufacturing sector is really sort of remaining fairly weak, and this is perhaps reflecting the fact that private capex is still fairly weak, rural demand is fairly weak, and the only real plus point has really been urban consumption, but that's really not strong enough to pull the figures higher. Exports are fairly weak. So overall, it does sort of highlight the general weakness in the sector.
Okay. Before I'll have to just cut you off. Electricity, in fact, Shivam, has come in at 14.6%. We keep talking about how electricity is a significant push in that entire basket. Rupa, what would you make of that before I bring in Ritu into the conversation?
Yeah, it's absolutely in line with expectations, the information on electricity generation, because last year, electricity generation was very low. So favorable statistical base effect has also contributed to this robust print for power generation.
Well, the manufacturing sector data is at minus 3.1%. The mining data is also out at 1.4%. Rupa, first reading, manufacturing obviously is a big dragger. On the mining front, what were your expectations? Because electricity as a as a basket has actually been doing well for quite some time. So no negative surprise there. What do you make of the mining sector data, especially in the light of the coal output?
No.
Yeah, please go ahead.
Absolutely, absolutely. You see, even my forecast was plus 0.8%, and it was entirely driven by, favorable statistical base both for mining as well as power generation. You see, we had seen in the core industrial production data also for the month of April, actually, coal output posted negative growth. But yet, the favorable statistical base has helped the mining sector as a whole. But otherwise, you see, overall mining activity is not very robust. What is really giving good support to overall IIP is power generation and some of the other basic goods like cement, steel, and refinery products, etc. But broader manufacturing activity is still weak on the back of very weak private investment sentiment, which is forcing capital goods production growth to stay in that negative growth zone, very high double-digit negative growth zone, as well as consumer non-durables, where also growth is very weak because of weak rural demand.
Ritu, some of the other numbers have also come in. So take us through that. Capital goods is not looking very strong, if I'm correct. What was the number for?
Capital goods, in fact, is down by about 20%. If you could pull up the numbers, that is something that the market's closely watch.
Negative 24.9%.
Minus 24.9%. In fact, much lower than what was expected. Last month, it was down 15.4%, but this is again a new high. Capital goods, consumer durables, and non-durables, more specifically, is the data that the markets will closely be watching for. Because remember, two-wheelers, all your auto companies, all of those fall in the consumer durable basket. The non-durables would be, your stocks like HUL, Britannia, Nestle. Those would, show the trend as far as those companies are concerned. Non-durable output is at minus 9.7% versus a degrowth of 4.4% in the previous month. You also have of course, can we bring in Rupa again? Rupa, for the entire year, how do you read this data? For this month, we've seen a sharp contraction. What do you make of the coming few months? Can we expect some sort of an improvement perhaps in the second half of this year once monsoons come? If they, as the IMD predict, are better than expected, could the rural demand pick up, and could we see IIP numbers also improving on the back of that later?
Yeah, sure. I mean, monsoon is going to have a critical influence on overall IIP trajectory in the financial year FY17. And it's not just the quantum of rainfall, but also its distribution. So maybe, we have to, but the first quarter, we may not see any significant pickup in overall IIP, because as you rightly said in your earlier briefings, the core sector growth has been decoupled from the broader IIP, and now the weaknesses are more in capital goods and consumer non-durables sectors, which are dependent on pickup in private investment and rural demand, which in turn, would be driven by overall monsoon performance. So I'm not very optimistic of IIP growth in the first quarter at least, but yes, monsoon will be a critical determinant of the future trajectory of overall industrial production sentiment.
Okay, let's quickly bring in Ashutosh Khajuria as well. Ashu, thanks for joining in. You heard most of the basic numbers. It's a negative 0.8% on the broader IIP figure. Electricity looking decent, fairly steady at that 14.6. But if you see the numbers with respect to manufacturing, with respect to consumer non-durables, even consumer durables is fairly okay right now. So what would you expect from an outlook perspective?
The consumer non-durable is quite okay. There is no challenge on that side. Only on capital goods, is the villain. And because of capital goods negative growth, the entire number has come negative. Okay. And as Rupa has rightly mentioned, it's because of private investment not coming in. So there is no new investment happening in, and orders are not being placed for a new capacity creation. So right now, I think capacity utilization is in the range of 70s. till it becomes 100% or closer to 100%, there would be no demand for creating new capacity. And this is the reason why we are seeing capital goods month after month is in negative territory, now at about minus 24%.
Okay, Shivam, quickly, last comments. What are the draggers this time and what would you be watchful for next month?
I think, yeah, as sort of most of the other guests have pointed out, I think capital goods sort of deserves attention. I think if you look at the trend, how it sort of performed over the last sort of fiscal year, it was really fairly weak, and then from June to maybe October, it sort of picked up a bit. That was really reflecting the public capex cycle picking up. So you could see a sort of a fairly similar trend that could sort of lift the capital goods component and sort of coupled with the fact that rural demand on the back of favorable monsoons and the government's increased focus in the budget in trying to revive the rural sector.
Right.
So there could be some improvement going forward. Another thing to keep in mind is that the IIP, it is rumored that the IIP base year, there will be some revisions on that front.
Yeah.
So you could see a general, like you saw when you had the new sort of GDP series, but you could see sort of some upward revision, nothing spectacular, but just a marginal upward revision over the course of the year, reflecting a new base and perhaps an increase in samples. So that's something to sort of watch out for as well.
Rupa, quick last words. Would you agree with Shivam in terms of the outlook?
Yeah, more or less. Growth is quite uneven at present. Certain sectors, as you rightly pointed out, have been showing good traction, like you see CVs or tractors or two-wheelers. But I think those, their demand factor has not improved as much. But, there are expectations about favorable monsoon also has been contributing to that optimism. Okay. But going forward, sustainability depends on the actual monsoon.
All right, Ashutosh, Shivam, Rupa, thanks for joining in. Before we head into that break, Ritu, quickly wrap up all the numbers that the market will watch out for on Monday.
Very, very weak IIP numbers, broadly in contrast with the GDP numbers that recently came out at minus 0.8%. That is a drag of 0.8% over March. Remember, these numbers come with a 2-month lag. The big draggers, of course, manufacturing and mining to some extent, electricity numbers, which is grown by 14.6%, in fact, is a 1-year high, whereas the manufacturing numbers is the lowest we've seen in the last very many months, in fact, since December. Capital goods also negative again, which is a big dragger. Consumer durables grew at 11.8%, non-durables at 9.7%, and basic goods at 4.8%. These are the key numbers that we have to keep the focus on. But of course, a very disproportionate picture being painted by these IIP numbers. Hopefully, as all our guests pointed out, with monsoons above normal, that is the expectation, rural demand could pick up, and that is something that could perhaps spur industrial production in the coming few months. But for now, industrial growth looks like it remains very, very weak and much below what was expected on the street.
All right, that's all we have on our special coverage.